started. Just a reminder, how many of y'all saw the worksheet that I posted? I guess I posted that worksheet on Monday. Okay. And then I posted the quiz yesterday. So make sure you take that, work on that, or finish that worksheet before you take the quiz. Okay, they're both due today. So make sure to get that done. I think last time I checked, let's see, 2 people had turned in the worksheet practice, and 1 person did the quiz. Okay, so just make sure that you take care of both of those things today. In terms of what we're going to be talking about today, I can answer any questions that you have on insurance in general, but I wanted to spend some time talking about life insurance. It's going to be a small part, like the test that we have on Friday is that's going to be posted Friday, and you have until Monday to finish it. It's mainly going to cover health, auto, and homeowners insurance. But there will be a couple questions on life insurance. I just want to talk about that in general. What sets apart life insurance compared to all the other insurance? What sets that apart?
Someone dies.
Yeah, someone dies, specifically the policy owner. So if you have all of those 4 insurances, life insurance is the only one that you're not going to collect on, right? Who does life insurance benefit?
The family of the person who died.
Yeah, or just people who are dependent on you, right? People who are dependent on you. If you have no one who's dependent on you, do you need life insurance? No, right? If no one is going to suffer financially, like there's going to be emotional suffering, right? But if no one suffers financially because you're not around, you do not need life insurance. Okay. So the people that do not need it, young people without a family, you don't need life insurance. Okay. If you get married and your spouse is the breadwinner, you could make the argument that you still don't need life insurance because your spouse is the one making all the money. Okay. If you get married and you're the breadwinner, you need life insurance. If you're married, but you're retired, and so you're not generating income from your labor, from your work, you don't need life insurance. Okay. So the people that need life insurance are the people kind of in the middle part of their life. Okay. They have dependents, but they're not retired. If you fall into the latter part, that you're retired, you don't need it because no one's depending on your income. Okay. Also, what are the odds that you're going to die in your lifetime?
100%.
100%. Okay. So the older you get, is it more likely or less likely that you're going to die? Yeah, it's more likely. So think of it in terms of premiums, right? The life insurance company is going to have to pay out these premiums to you. Let me rephrase. The life insurance company is going to have to pay out the policy. The older you get, the higher risk that you're going to die, which means the higher risk that the insurance company is going to have to pay out. Do insurance companies like paying out? No, right? So what they're going to do is they're going to increase your premiums. Someone who's 30 can buy a life insurance policy cheap. Someone who's 70, that's similar life insurance policy is going to cost them an arm and a leg because the chances of them dying are much higher. Okay. So that being said, there are two main types of life insurance policies out there. There are more than two, but these are the two main categories. There's term life and there's whole life. Term life will last you for a certain number of years. It'll cover you for a certain number of years. Whole life is permanent, meaning it will stay with you your entire life. Okay. Which one do you think is going to be more expensive? Let's say we have a $100,000 policy for term and $100,000 policy for whole life. Which one will be more expensive?
Term.
Term. Oh, no. Sorry, whole life.
Okay. But for term, wouldn't you just keep paying it if you want to keep it?
So you would pay it. Yeah, if you wanted to renew it after its term, you would keep on paying the premiums and it could get expensive. But typically people, like let's say someone is 40 years old, they will buy a 25 or 30-year term policy. When they're 40, they lock in that rate and they pay that same rate every year until the end of the policy. If at the end of the policy they want to renew it, it's going to be a lot more expensive because at the time they're renewing it, they're now 75 or what did I say, 70 or 65, somewhere, whichever one I said, 25 or 30 year policy. Okay. But that same policy with a whole life, okay, you're going to be covered your entire life. What are the odds that that insurance company is going to have to pay out on that policy? %100%, right? So if the insurance company is going to have to pay out, if it's 100% certainty that they're going to have to pay out that on that policy, then the amount that they're going to charge you in premiums over the course of your lifetime are going to be greater than that policy payout because they have to make money somehow. Okay. Whereas the term, if you're 40 and you're buying a 25-year term policy, what are the, I mean, is it a certainty that you're going to die between 40 and 65? No. So you're going to pay out a little bit less. You're not going to pay out, if it's a $100,000 policy, you're not going to pay $100,000 in premiums over that course. Okay. Because with a term, the risk of the insurance company having to pay out during that time frame is lower than whole life because they're going to have to pay out. So if you have two policies, term and whole, and the term is they're both $100,000 policies, okay, and you get the term for your working career, then the term is going to be, the premiums on the term are going to be a lot cheaper than the premiums on the whole life. Okay. Now here is, so I had an attorney friend who contacted me about a year or two after we graduated from law school with a financial question. He's working in New Mexico, and he said, "Hey, so this insurance salesman has come to our office, and he's talking about selling us whole life life insurance plans as an as an investment, kind of as a retirement fund type deal." That's when whole life can get pretty complicated, because you at a certain point with whole life you could start taking money out of it. But what you're doing there is you're combining insurance with investments. More people are having to manage your investments. And when you have more people having to manage your investments, what happens to the fees that you pay? They go up, and it's not necessary, right? You could get the same type of investments on your own using mutual funds or ETFs, and you don't have to pay those added fees that the insurance company is going to charge you. So the advice I gave him was, hey, insurance is supposed to be insurance. It's not supposed to be an investment. You don't buy insurance with the idea that if something bad happens, you're going to become better off. Insurance doesn't work that way. Okay. So keep that in mind. Just stick with term. If someone needs life insurance, stick with term. It's going to be cheaper. Okay. Any questions over that? No. Okay, so there are going to be a couple questions on that life insurance. I'm recording this, so if you wanted to go back over and review what we just went through with the two basic types of life insurance, you can. Okay. Any questions on homeowners insurance? Okay, Leo, I'll answer you. Yeah. Okay. Okay, so one aspect, this one I can answer, or this part of the question I can answer publicly. Just remember, liability covers things that that you would otherwise be responsible for. Okay, that's happened to someone else. Damage, it happens to a third party. You're responsible for that damage. If you don't have liability protection, you have to pay it out of pocket. With liability protection, though, that liability coverage would, the insurance company would pay that third party. Okay. Remember that. So that's, you have someone over, let's say you had someone over at your house, and they had, I don't know, a suitcase full of money. Okay. And your dog gets into the suitcase and chews up the money. Guess who's responsible for that? You are, right? So that would be kind of a liability aspect. Okay, let me take a look at this question, make sure I put it correctly in the answer to you. Okay, Leo, on your first question, about the differences between HO6 and HO3, do you know which question you're referring to on that? It's on the worksheet, right? I'm just looking over the worksheet real quick. I don't see a question. Oh, okay, I see this. That put the ew. Okay, I see which one. So that is a typo. There's a question. I'm going to go in and change it real quick. Leo and who else took it already? Leo and Daniel. I'll make sure that y'all get credit for it. That's not supposed to be H06. It's supposed to be H05. That's what I meant when typing it up. Okay, but I'll make sure that y'all get credit for that. Does it make sense with it being H05 rather than H06? Yeah, yeah, yeah. Little typo area. Okay. Any other questions? Y'all want class time to work on your worksheet and quiz? Anthony is saying no, you don't want class time. Okay, but you haven't finished it yet. So yes, you're gonna have class time. I'm gonna leave this this video open. Okay, if you've already finished your quiz and worksheet, you can go ahead and sign off. If you have not finished, I want you to just go ahead and work on it for the next 20 minutes. And I'll leave this open. So if you have any questions, you can ask me, okay? And I'm just gonna stop the recording now.